Is Plug Power potentially a really bad investment, or is all the skepticism on social media and outlets pure FUD? In this video, I want to address that question by analyzing and reacting to a video conducted by another fellow YouTuber about the massive losses that Plug Power is currently sustaining, even though they've been in business for over a decade. I'm sure we can all agree in saying that Plug Power is probably the most important hydrogen fuel cell business on Earth today, but there are some serious concerns about whether or not this company can actually return money to investors over the next 5 years, as historically the company has always struggled to turn a profit. And well, that question is exactly what I'm going to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to address some of the big news catalysts we have seen over the past 2 weeks that have actually increased my conviction in Plug Power's electrolyzer business. As you can see, recently Plug was involved in the deployment of the world's first offshore wind power plant that produces green hydrogen using Plug's leading electrolyzer technology. This was done in partnership with a company called Life in Europe that essentially creates and finances hydrogen projects through wind farms and solar farms, which obviously are going to be the #1 source of hydrogen production in the future, and as demand for the fuel continue to go up. But obviously the problem is that if you're not able to do this profitably at scale, then you're going to get no investors who are confident in investing in your stock or your business, because obviously at the end of the day, they're looking for a return on their capital. And even with the Inflation Reduction Act, which is going to provide a production tax credit of $3 per kilogram for hydrogen, which will make it much easier for Plug to scale up its electrolyzer business, there are still some serious questions as to whether or not Plug stock is overvalued, which could lead more selling in the next 5 years than buying. And to address that exact point, I'm going to now react to a fellow YouTuber who conducted a revenue and margin analysis on Plug Power's business to explain why he is not confident in Plug Power's ability to turn a profit.
So you can see that the green hydrogen that Plug Power is going to be supplying, so this would be hydrogen from green sources like solar or wind. They're going to be supplying about 11,000 tons per year of liquid green hydrogen. And that's starting in 2025. So this is a few years off, but a pretty notable number. But this is what's really important here is that Plug has given Amazon warrants to acquire 16 million shares of stock at about $23 per share. Now, this is consistent with what Amazon demanded the last time they made a deal with Plug Power. They got warrants in their 2016 deal. Really tells you where the power dynamics are between these two companies. Plug Power isn't just a normal supplier. This is a supplier that has to literally give Amazon stock as upside just to make a deal with them. Now I think it's worthwhile to go back to 2016 and look at what the financial results were for Plug Power after they made the Amazon deal. And note that they had a deal with Walmart at a similar time as well. So we can look at revenue has really gone up since then, $502 million in revenue in 2021. That's really impressive from $83 million in 2016. But look at that net income line. Plug Power is just burning cash. If you're burning cash to grow your business, where do you get that money from? Well, you sell additional shares. And that's exactly what you see here in the shares outstanding, 182 million shares outstanding at the end of 2016. By the end of 2021, that number was 577 million shares outstanding. Now think about that as an investor. Revenue is up more than 5x since 2016, but shares outstanding are up over 3x. So you're not getting nearly as much benefit as you might think. And in addition to that, the company is losing money. So there's no earnings to be shared with investors. Now, you may say the company is just investing in growth, but I have to wonder where this is going to stop. Plug Power has for a really long time said it was going to be cash flow positive. That just simply hasn't happened. And the company continues to issue shares. And it's really worrisome that it has to issue warrants to a company like Amazon just to get them to assign a hydrogen deal with them. I see this as a continuation of the same story for Plug Power. They're really good at making big, grand announcements. They're really good at growing revenue, but they're just burning cash year after year. They continue to dilute shareholders, and I don't see any end to that in sight. That's why this is just a stock I am going to stay out of. It's too risky for me, and I think there are better options in the hydrogen space.
So obviously a lot of information to digest, but let's start off with the Amazon point this person made, where he mentioned that Plug Power is giving warrants to Amazon to buy their stock in the future, as a deal for them to partner with them for fuel cell forklifts. Now, I will tell you straight away the reason why this is not a red flag for me. Because Amazon is asking for stock, not for royalties, which means they have confidence in an appreciation for Plug Power's business. Otherwise, why would they risk investing in warrants when they could simply ask for royalties from Plug or any sort of other cash payment? And it's funny because Amazon did also sign an agreement with Plug back in 2016, which is also when they were assigned some warrants, which Amazon happened to actually exercise. And obviously since then, the stock has gone up over 10x, so that might put into perspective exactly the thought process that Amazon has. Amazon's investment horizon is not 1 or 2 or 3 years. It's multiple decades. We've already seen that with the amazing acquisitions Amazon has already done in the form of Whole Foods and obviously now Rivian, who has been an EV company for almost 10 years. And so this does give me confidence in Plug Power's ability to scale and grow their electrolyzer and fuel cell business if such a well thought out business is investing and partnering with them. But obviously that was not all of it. There was also a big point raised at the end of that video where he mentioned that Plug Power has never turned a profit even though these guys are growing at a crazy rate. As you can see, growth over the past couple of years for Plug Power's revenue has been absolutely insane, even though in early 2021, we did see a negative revenue quarter, which was because of an accounting problem they happened to raise. But obviously the problem here is that their gross profit, which is essentially the cost of goods sold subtracted from their total revenue, is still negative, which I'm not going to lie, is definitely a concern. Now, it's hard to pinpoint as to what exactly the cause of this is because it could be stock-based compensation or it could be simply that the cost of goods sold has increased a lot with inflation. But overall, their R&D has gone up significantly, which could be a component for this as they continue to invest in their own growth. But unfortunately, one of the other red flags is that Plug's SG&A expenses have also skyrocketed actually at a faster rate than their R&D, which means they're either spending way too much money on hiring people or are going through sales channels that are absolutely ripping them off. And so as a result, as an investor, that is something I do want to see come down over the next 2 years as some of their high investments in electrolyzers and fuel cells start to really pay some dividends. And this should hopefully start reflecting into a positive operating margin by 2024, which is something the CEO has already said is one of Plug's main targets. And as for whether or not all the investing that Plug is doing today is really gonna pay off, there is absolutely no reason and no way for us to find that out apart from just being patient and seeing how the business evolves. Because Plug is going a very different strategy because of their amazing capital position and the very minimal debt they have on the balance sheet. What this has allowed them to do is invest in very thought out partnerships like their one with Hyvia in Europe to commercialize commercial fuel cell EVs. And simultaneously, their South Korean partnership with the SK Group has also paid some dividends as their electrolyzer business starts ramping up in Asia. And the good thing is that a lot of analysts do understand this. Plug has set out a target to build massive hydrogen plants in North America, which will be producing over 70 to 100 tons of hydrogen gas per day, which is obviously a very, very ambitious goal, and it will require a lot of upfront capital investment. Plug really wants to maintain its leadership in this market. And with the way that the hydrogen industry is evolving, I am very confident that if these investments from Plug really play out and pay out big dividends, then the company's stock will be significantly higher than where it is today. But of course, for some folks, that is a gamble, and it's very hard to make that kind of decision with so much minimal information today, especially when all you're seeing are losses and losses in the short term. And well, that is basically how the stock market works. You're balancing a reward potential with a risk, and it's your job to manage both sides of the coin as equally and fairly as possible. And right now, this is what I'm doing with Plug Power and all my other individual stock picks. And obviously everything I've shared is just my opinion, so feel free to let me know your thoughts down in the comment section below as to whether or not Plug is a more risky business than many people would have initially thought.